On the floor of the New York Stock Exchange, asking seasoned traders about a unified BRICS currency typically elicits one reaction. They laughed. Their skepticism is based on sheer scale. 90% of all foreign exchange transactions involve the US dollar, providing a level of market dominance that seems impossible to uproot. There is also the matter of hard assets. To back a credible currency, you need gold, and the United States holds roughly twice as much as all the BRICS nations combined. Looking at these traditional metrics, US financial supremacy appears invincible to any conventional geopolitical challenger. But history shows that reserve currencies are not permanent. The British pound ruled global trade for over a century, and it took the total upheaval of a world war to finally unseat it. Today, the dollar is more than a medium of exchange. It is a weapon integrated into the SWIFT network, the primary messaging system used for global bank transactions. By leveraging this network, the United States can isolate adversaries, severing their global connections and freezing foreign reserves. When sanctions hit Russia, the sudden loss of SWIFT forced them to use local currencies, or barter with produce, to maintain trade. For rival nations, this level of dependency is a critical vulnerability, one that makes escaping the dollar system a matter of national sovereignty. The most discussed solution is the creation of a physical BRICS currency, a proposal often championed by leaders at summits in places like Kazan. However, a unified fiat currency requires deep political alignment. The BRICS members are too economically diverse, with different inflation rates and conflicting trade priorities, to manage a single money supply. China represents over 2/3 of the bloc's total GDP. A shared currency would likely become a vehicle for Chinese hegemony, trading one master for another. Nations like India and Brazil remain cautious. They are reluctant to surrender their monetary independence to a centralized system dominated by their neighbors. While a physical BRICS coin faces massive logistical hurdles, the public debate around it serves as a distraction from a much more effective strategy. The real strategy is the development of a decentralized digital infrastructure, building an alternative plumbing for the global economy that functions by bypassing the dollar. This takes the form of BRICS Pay, a planned messaging and settlement system that uses blockchain technology and digital tokens to move money across borders. China is already utilizing the digital e-yuan for international crude oil settlements, proving that high-value commodity trade no longer requires the greenback. Projects like emergence enable central banks to transfer digital currencies directly to one another, removing the need for US-led clearing systems. Because this digital plumbing is independent, traditional financial sanctions lose power. There is no central point to pull the plug. This invisible siege aims to make the dollar optional. By constructing an independent circuit, the bloc ensures that global trade can seamlessly continue, completely regardless of any shifts in US policy. While the public face of Wall Street remains dismissive, the actions of major financial institutions suggest a growing internal anxiety. 63% of global investors are now hedging against dollar declines, a multi-year high. These traders are spending billions to protect themselves from a potential drop in the greenback's value. Even the New York Stock Exchange is frantically modernizing, shifting towards digital platforms and faster settlement cycles to keep pace with these emerging decentralized technologies. Publicly, the dollar is king, but privately, the largest players in finance are insulating themselves from a systemic shift they can no longer ignore. We are seeing the rise of a financial splinternet, where the global economy fractures into competing digital silos. Nearly 3/4 of the G20 are rolling out tokenized systems, leaving us with a patchwork of incompatible regional platforms. The dollar remains the primary reserve currency, but it no longer holds a monopoly on the infrastructure of international trade. In this new decentralized arena, the dollar must compete on its merits, rather than relying on the fact that there are no other options. Digital protocols and independent payment rails have become the primary tools for reconfiguring global financial power. To understand the hidden forces behind the money in your pocket, make sure to like this video and subscribe to Dollar Logic USA. What happens to the global economy when the world's most powerful currency is quietly dismantled, all while financial experts laugh? Right now, the US dollar sits comfortably on the throne of global finance. It is involved in 90% of all foreign exchange transactions and acts as the undisputed backbone of the SWIFT network, processing a staggering $150 trillion every single year. So when traders down near the intersection of Wall Street and Broad Street were asked about the threat of a unified BRICS currency replacing the dollar, they literally laughed at the idea. Look at the leaders gathered here at the BRICS summit in Kazan. Wall Street is completely right to doubt them. The economic systems and political goals of these nations are deeply mismatched. The idea of them trusting a single euro-style paper currency managed by a shared central bank is highly improbable. Add to that the sheer volume of hard assets. Deep inside facilities like this high-security vault, the United States holds roughly twice as much physical gold as all the BRICS nations combined. But the confidence on the trading floor relies on a severe miscalculation. The experts are looking for a rival fiat currency, and they are completely ignoring the asymmetric tactics actually being deployed against them. A decentralized technological override designed to bypass the US banking system entirely is the primary mechanism for challenging American financial hegemony. The initial attacks on the dollar's dominance have been highly physical. Emerging economies in the global south are aggressively accumulating physical gold, securing hard assets to back their trade, while the United States continues issuing unbacked debt. This shift went into overdrive following the financial sanctions leveled against Russian President Vladimir Putin. When the US responded to the invasion of Ukraine by disconnecting Russian banks from the SWIFT network, rival nations realized the dollar could be weaponized against them at any moment. To evade that risk, countries began settling bilateral trade using their own local currencies, avoiding the dollar clearing process entirely. This chart shows the tangible impact on global supply chains. As you can see, US imports from China have steadily declined, while the Association of Southeast Asian Nations and the European Union have actively rerouted their import structures to rely less on traditional dollar-denominated pathways. But bartering in a patchwork of rupees, rubles, and yuan is incredibly clunky. It takes time, carries high exchange risks, and struggles to scale across global markets. Stockpiling bullion and trading on local ledgers serve as analog stopgaps. These nations are using them to buy time while they finalize a new cross-border digital architecture. Enter central bank digital currencies, or CBDCs, and blockchain initiatives like BRICS Pay. These are state-backed, programmable successors to the legacy SWIFT network. This map highlights the sheer scale of the rollout. By 2026, nearly 3/4 of the G20 nations, including major economies like China, India, Brazil, and Australia, will have live or piloted tokenized systems designed for cross-border retail and wholesale payments. Tokenized rails operate completely differently from the traditional banking system shown here. Instead of money bouncing through a slow, multi-bank SWIFT transaction path, the new architecture moves digital certificates instantly from point to point, completely cutting American correspondent banks out of the loop. Chinese President Xi Jinping has positioned his country at the forefront of this architecture. China's eCNY and the multinational mBridge project currently serve as the most advanced operational frameworks for this exact type of cross-border settlement. If you think these digital rails can't handle global demand, this chart compares transaction volumes of major financial networks. Dollar-backed stablecoins alone processed roughly $10 trillion in a single year, easily rivaling the payment volumes of legacy giants like Visa and PayPal. The pressure from this technology is forcing traditional institutions to adapt immediately. Look at the legacy infrastructure on the New York Stock Exchange floor. To avoid obsolescence, even the NYSE is now rapidly advancing digital trading tools and pushing for real-time settlement. If global commerce successfully migrates onto these non-dollar digital rails, Washington loses its structural advantage. The US will no longer be able to surveil international transactions, and its ability to enforce economic sanctions will evaporate. While these digital networks expand globally, lawmakers inside the US Capitol are compounding the problem. The government is executing massive new stimulus plans, while simultaneously piling up the highest levels of national debt seen in a century. This creates what economists call the debtor's dilemma. Following the pandemic, central banks actively bought up public debt. Now they are unwinding their balance sheets and selling it off. leaving the United States entirely reliant on foreign private investors to fund its deficit. As global investors start utilizing BRICS digital rails and ramping up their defensive hedging against the dollar, foreign appetite for U.S. debt will shrink. Without that cheap borrowing power, the Treasury will offer much higher yields to attract buyers, driving domestic mortgage and interest rates sky high. Global reserve shifts happen slowly, until they happen all at once. Look closely at the delegates gathered at the 1944 Bretton Woods Conference. The U.S. economy surpassed the UK in 1916, but it took nearly 30 more years and a world war before the dollar fully supplanted the British pound. In the coming decades, the structural financial power will shift toward those who control the world's digital ledgers. Thanks for watching. For more on the macroeconomic forces shaping our future, subscribe to Dollar Logic USA.